thank you so much for coming back. Today we'll be looking at four main asset classes: cash, bonds, equity, and property. Unfortunately, we'll not be looking at cryptocurrency in this video, but hopefully in future. Before we do begin though, kindly be reminded to please share this video with everyone. I'm trying to get to 100 subscribers by the end of December, so please do hit subscribe and share this video. Let's get into it. Cool, so let's get into cash, being our first asset class that we're looking at. Cash is usually the money that the day-to-day money that we have, but it is also the money that we have in savings accounts, just laying there, saving it, and also money that we have invested into the money market. Okay, now cash is usually a short-term kind of investment class, and it is known as a parking bay. So you're basically parking your money in the asset class cash for a while before moving it on to a different asset class. Cash is low risk, which means low returns if you are comparing it to the others as well. However, the nice thing about cash is that if it is easily accessible. So in the event that you have an emergency and you cannot wait 3 to 4 days to have to cash in your other investments, the asset class cash provides you with immediate liquidity when you need it. So that is a nice benefit of having cash. And then also, how do you make money from cash? By the interest that you would receive from your savings accounts or your money market account as well. So there's definitely benefits to having cash as part of your portfolio. Our next asset class is bonds. So I'm referring to corporate or government bonds. So let me just briefly explain. A bond arises when the government or a company wants to perform a project, but they do not have enough money for it. So they go to the public and they issue out bonds for the public saying, look, give us, invest in us, give us a certain amount of money, and in return, we'll give you a set interest rate on the capital that you provided us with. So a good example would be the government wants to build a road from the N1 to Timbuktu or wherever, and they then issue out bonds to the public, and the public can go and invest, give them the money to complete the road in return for that set interest rates. Now bonds are not very high risk, which is really nice. It provides that stability in your investment portfolio because of that set interest rate, and it is best to be invested for a long term if you are thinking of bonds as well. So definitely pros and a few cons as well, but do your reading for yourself too. Then we move on to equities. So equities, or shares as we know it, is when you buy a part of a company and you become a shareholder, as the name suggests. Now shares are, yes, high risk, high reward. It is very volatile. However, the potential for high rewards are definitely in shares. Now shares, it is best to stay in for the long term, especially if you are thinking of investing. It is best to stay in for the long term, and also to be able to stomach market changes or fluctuations, because the price of shares increase and decrease on a daily basis. So be willing to stomach some market changes. Okay. Now, the nice thing about shares is that you make money when the company does well and the share price increases. So then you make money, and you also get companies that pays a dividend to their shareholders. So not all companies does this, but you do get companies that actually return dividends to their shareholders. They usually say if the company is making too much money or a lot of money, then they reward their shareholders by giving them dividends. So that's like an extra incentive, if you want to call it, for being invested in shares. And then we get properties, our fourth asset class, properties. Now, properties can be divided into two subsections. So you get the property that is registered in your own name. So you actually like the physical building that you go and buy, registered in your own name. And then you also get listed property, which is also a really nice investment choice for many people that want exposure to the property market. So property is usually a medium to high risk kind of asset class, not as high as shares, but if you are going into listed property, it could be as high as shares, but it is medium to high risk. And also think of it as medium to long term, that you need us to stay in the property market to really be making money out of it. Now, how do you make money from the registered property in your own name? That one would be the rental income that your tenants would be paying you. The one downside to having the physical property in your own name is that the total responsibility is on you to maintain that property, which usually also comes at quite a cost that people tend not to tell you, but it does come at a cost. And then you also get the listed property. So listed property is similar to shares, where you actually buy a part of companies that own and manage different properties. So like malls or flats or whatever they own. But you actually buy a part of that, similar to shares. And you also then get dividends or returns from that as a shareholder in those kind of properties. So there are lots and lots of them out there. And the nice thing about being invested into listed property is that you don't have worries about maintenance or the tenants that are going in there. Your greatest concern is getting the money, and that is what investment is all about. Investing is about making more money, babies, as someone once said. And that is why we have to quickly look at the term diversification. Now, the book definition of diversification is that it is a risk management strategy that mixes a variety of investments to mitigate the risk. Okay? Very complicated. But think of it like this. Ever heard the saying of don't put all your eggs in one basket? Now, that is diversification in a nutshell. The eggs being your money babies, and the baskets being the various asset classes. And the idea behind diversification is that when one asset class is performing poorly, the others that is in your portfolio should be able to make up for that loss, or more or less try to mitigate the risk in some way, so that you don't have a total complete loss in your portfolio. So yes, I know this is information overload, but remember, as we are all different people, our financial goals are also different. And that is why it is good to have a well thought out financial goal. And then also to get to know your risk profile, because that will also help you diversify your investment to reach your financial goal. If you missed the episode on risk profiles, go back. Please do check it out for me. But it is really good to diversify your portfolio and read up on the various options that you have. Okay, but also speak to a financial advisor. A good one will be able to give you good solid advice, and also shop around for a good one if you do not have, you'd feel that you do not have a good one. So remember, hit like, please subscribe, and share this video with everyone you know. Till next time.